Yes, we can.
Okay. Yeah, so the topic is IAS and IFRS in case study. IAS, IFRS in case study. So, like I was saying, how can you know what the examiner is testing? In some instances, they will mention the particular standard that that case relates to. In fact, most instances, they will mention the case, they will mention the standard, and then they will give you a scenario, and then you are to form your judgment and express your opinion based on the information contained therein. So what you are going to do is, based on what the standard says, and the case or the issues in that scenario that they've presented to you, what is your own position? What is your stand? What do you think? So we are going to look at November 2022, that they tested IFRS 9 there. Then we are also going to look at May 2022, where they tested inventories. Also, in June 2023, two standards were issued. And although they've not tested about any of those standards yet, it is very possible that they will test these standards. So those two standards are IFRS 1 and IFRS S2. So we are going to look at all of that. So let's go to November. Let's start with May 2022. Let me share the question on the platform. Yeah, so when you have case study before you to attempt, I mean, I usually tell students to go straight to the requirement. Can you all hear me? And can you see my screen? Please confirm so that I will continue.
So we can see your screen, but we've not seen the document in the WhatsApp group.
Okay, let me resend it. So I've sent November and May, all 2022. So go to page 164 of the May 2022. 164, page 164. That's where we are. Page 164. So at this level, I'm not going to I'm not going to start teaching you what is IS2. No, because you know all of that, you know IS2, you know what it is all about. So what we are testing here is your knowledge. We want you to apply that knowledge and attempt these questions. So we have here before us the case of a company that is specialized in the fashion industry, right? So like I said earlier, when you have a case before you, go straight to the requirements. So when you read the requirements, it will help you to narrow down to the relevant things to look out for. But by the time you start reading the case from the beginning, when you are in the hall, you may be confused. The reason why you don't need to start reading the case from the beginning is that you must have read it while you were preparing for the exam, because they will give you pre-scene. So you will use the pre-scene, you familiarize yourself with the case, and then when you get the unseen in the exam hall, all you need to do is go straight to the requirement, check the exhibit that contains the requirement, go straight to the requirement, see what they are talking about, and then try to attempt the question straightforward because you will not have enough time. Time may not be on your side. So you need to use every means that you have available to maximize your time. So you may need to be time conscious. You really need to be time conscious because time may not be there for you. And then you will also need to do your calculations and write your report at the same time. Can you all hear me? Because some of the things I'm saying, I'm already giving you tips. So you need to do your calculations and your report writing at the same time. The reason is if you focus only on calculations alone, you may not have time to write your report. You may not have enough time to write your report. By the time you are done with requirement 1 and requirement 2, it is likely that you may just have few minutes to do your executive summary. So that is why you need to be time conscious from the beginning. Do we have the May 2022? Do you all have it? Please indicate so that I can continue.
Yes, sir. You said what page?
Page 164.
Okay, sir.
Page 164. Just let me know when you're there. Page 164.
I'm there, sir.
Okay. So that's the page that contains information about the standard that we want to treat. So now, remember, I didn't start from the beginning. I just came, I'm just picking it so that we go straight to the point and I will explain. But like I said, you need to look at the requirement. So let me take you to the requirements before we come back to that page 164. Yeah. So let's read this, look at this together. Exhibit 5, email from Dasuki Saidu to Tunde Taiwo. So I've just received an email from Helen Thomas, BPE Fashion's finance director, asking us to evaluate the company's financial performance from 2018 to 2020 and benchmark them with equivalent reports of 3 of their major competitors based on selected key financial indicators attached Exhibit 7. The company will also want us to evaluate 2 business proposals contained in Exhibit 8 to 10 and report on our findings. Also, Helen would want us to comment on the application of IAS 2 to certain items in the management accounts, as well as assisting the company in evaluating the adequacy or otherwise of the company's inventory obsolescence allowance for 2020. She's willing to provide more details from the company's inventory management system to assist us in this regard. I'm attaching to this email Exhibit 6 to 12 in respect of the above. Please draft for my review a report addressed to the board of Best Price Fashions. The report would comprise an evaluation of the company's performance in the previous 3 years, 2018 to 2020, using the key financial indicators provided and benchmark them with equivalent figures from 3 of the company's major competitors. Also, let me have your comments on the treatment in the management accounts as mentioned by Helen, the 3 items covered by IS2. Furthermore, let me know other reports we may need to ask for from BP Fashion's Information Systems Manager to enable us properly evaluate the inventory obsolescence allowance in the 2020 financial statements as requested by Helen. Requirement 2, evaluate the two business proposals in financial terms and make appropriate recommendations to the board of BP Fashions. Also, review the key risks that may be associated with these two proposals and advise the board on how to manage the identified risk. I will expect your report in the next 2 weeks to enable me carry out a review and submit to Helen for BP Fashions board in the next 3 weeks. In case you need any clarifications, feel free to see me. I look forward to receiving your draft report. Saido. So that is the requirement. So our focus today is on requirement 1 that is talking about, just a part of it, the IS2, because our emphasis today is on accounting standards in case study. So they've referred us to the exhibit that contains information about IS2 as it's applicable to the case. So it's exhibit 11. Exhibit 11. So we'll go to exhibit 11. Prosper. Hello,
Sir,
Prosper.
I
Okay.
can hear you.
Adedayo. Adedayo.
Sir, yeah, I can hear you.
Okay. Fidelis.
Hello, sir. I can hear you, sir.
Maya or Maya.
I can hear you, sir.
Okay, great. I just want to be sure that you guys that we are together. So because I'm about to go to the main thing now, that's why I'm trying to draw your attention. So they've given us insight. So usually when you have a requirement and the requirement mentions a particular exhibit, it means that there's information that is relevant that is contained in that exhibit. So you need to go to where that exhibit is located and get that information. So they referred us to exhibit 11, that's where the information about the treatment of items under IS2 is located. So we are going to that exhibit now to see what is contained there. So this is it, page 164, treatment of certain items under IS2. So this particular scenario, it's going to be interactive because it's a kind of, what is your opinion? What do you think? So I don't want to be calling names, but I want to believe if I ask, you should be able to give me your opinion, right? So treatment of certain items under IS2. I need your opinion on 3 specific areas in IS2. These are: 1, storage costs. IS2 states that storage costs should be excluded from the cost of inventories. To me, that makes no sense when it comes to management decision-making and control. For example, at BP Fashions, our business is seasonal, and we need to order and store large quantities of products for a number of months. Therefore, the cost of storage is inextricably linked to the cost of merchandise. To include this cost in other operating costs would not be reflecting the true cost of our merchandise. So, what do you think? Let me know your opinion. I'm throwing the question to the class now. IS2 is saying that storage costs should not be included, right? As part of inventory. Storage costs should be excluded. But the BP Fashions is saying their business is seasonal and they usually order and store large quantities for a long period of time. So they are considering treating storage costs as part of the cost of merchandise. That's the cost of inventory.
All right, sir. Can I try?
Yes, of course.
I think what needed to be added to the cost of inventory normally used to be any expenditure that is incurred to ensure that the very items or the materials comes to the warehouse or where they are supposed to be stored. So normally it's meant to be added. In this case, I will say storage cost should be part of inventory because the company have explained to us that it's going to take them a longer time or a duration that was not planned for the inventory to be stored. So in that case, it's going to be forming part of the cost for the inventories.
Okay. All right. Thank you for your opinion. Any other person? Hello.
Hello,
Zainab.
sir.
Okay. Adedayo.
Yeah, the the BP fashion is letting us know that because of their type of business is a seasonal business, and then they need to like order much large quantity, and then which will require them a lot, which will require loss of as much in cost of transportation and all to the inventory. So they feel that they should add that their cost of inventory as part of the cost they incur.
Okay. Thank you for your comments. Do we have, okay, we have a chat here. Oh, Zainab. Oh, okay. We got your message. Any other person? Okay. So, yeah, I think that you guys have expressed your opinions, and I won't say no, because in case study, the way you look at a particular thing may not be the same with the way another person looks at it. But what is important is what is generally acceptable. So whenever you have a scenario where the management is taking a decision or the management is treating certain items in line with what they do, it means what is happening here is that because the company BP Fashions is incurring a lot on the storage, they think that the storage cost should be part of the cost of inventories. But the standard states categorically that I don't want to go into the treatment of inventories because this is not inventories class. It's just for us to apply that knowledge to solve this question. So the point I was trying to make is that when the standard states or makes a provision, that provision will supersede any other thing that the management is doing because the management is supposed to follow the standard. Are we together?
Yes, sir.
Yes. So, like I said, the standard states that inventories, storage cost is not part of the cost of inventories. The first person that spoke, I think that was Fidelis, if I'm right. He said the cost of bringing that inventory to its useful states is going to be the part of the cost of that inventory. But the storage cost, is it the part of the cost of bringing the inventory to its current state? No,
No,
it's not. It is not. It is just the cost of them keeping that inventory so that whenever they need to sell, they will sell. So even without them storing, they can sell. They are the ones that decided to store because the inventory is ready for sale, right? But because they want to order in bulk, they have to pay a lot of money to store this inventory so that they will sell eventually. So it is also possible that they can just, as they are ordering it, they are selling it without cost being incurred. No. Do you guys understand the point we are making?
Yes, sir.
So when you are faced with a scenario like this, always tip towards the side of the standard. You'll be more, even though it is not wrong for you to express your opinion, but you must give convincing reasons. You must give convincing reasons. So because it is an exam and you don't know who is going to mark your script and you don't know the mood that that person may be in, so if you now align with the management's opinion and you don't give the person convincing reasons, chances are excellent that you may not score very well in that regard. So always follow the standard. Okay, let's move on. If you are good with that, can we move on to the next one? Inventory write-off. Someone should read for us, please.
IAS 2 maintains that obsolescence allowance, inventory write-offs, and shrinkage in the cost of inventories be expanded, be expensed, be expensed. However, I think inventory write-offs are the result of poor planning by the buyers. So there's no reason punishing sales departments for higher inventory costs when the buyers made the mistake. I therefore think reporting inventory write-off as a separate line item in other operating costs in our monthly management account provides a better information. Also, you will agree with me, inventory write-offs are so easy to manipulate from year to year by varying our procedures for identifying slow moving inventory so as to achieve a desired level of gross profit percentage.
Okay, thank you very much, Adedayo. So just like we discussed the first one, it's similar to that one. It has to do with inventory write-offs. First, you need to understand what is inventory write-off for you to know how to treat this. And I want to believe you understand what inventory write-off is. So IS2 maintains that obsolescence allowance and inventory write-offs and shrinkage in the cost of inventories be expensed. So IS2 has classified the three of them that they should be treated in the same way. Obsolescence allowance, inventory write-off, and shrinkage in the cost of inventories. They should all be expensed. Now, that is the provision of IS2. But they are saying that inventory write-offs are the result of poor planning by the buyers. So there is no reason punishing the sales department for higher inventory costs when the buyers made the mistake. I therefore think reporting inventory write-off as a separate line item in other operating costs in our monthly management account provides a better information. That's the first point they are making, that the buyers are responsible for the inventory write-off. Now, how convincing is it that the buyer or the buyers are responsible for write-offs in the value of inventory or in the inventories? How convincing? Then they are also saying that inventory write-offs are so easy to manipulate from year to year by varying procedures for identifying slow-moving inventory so as to achieve a desired level of gross profit percentage. So another point they are making is that it's very easy for inventory write-offs to be manipulated. It is possible that, let's say, the company made sales and the products are faulty and the customers eventually return them. So if they've decided to write off such inventory, is it the fault of the buyers that the inventory was written off and then, or is it the fault of the company because they produced the product, they made the product, and IS2 is saying expense the cost of inventory write-off. They are saying they want to put it as separate line items in their management account under operating costs. Once again, what is your opinion? What do you think? Like I said earlier, it's going to be interactive so that you understand. That is the reason why I'm asking all these questions, so that you understand what we are talking about. Even though I need to be fast so that we meet up with time, because we still have November 2022 to look at, and also IFRS S1 and S2. So let me know if you have comments on this before I conclude, before I discuss further. Adedayo, Fidelis, Maya, Prosper, Zaina, Blessing, believe, I believe. Hello, guys.
Hello, sir.
Yeah, Adedayo, any comments, any opinion? What do you think? Yeah, so what you need to know, or what you need to do, is that I said it earlier, that when any treatment or any decision by management contradicts the provisions of the standard, you should always follow the standard, right? So even if the question is not the way you want it to be, or even if the question, even if you are finding it difficult to understand what they are saying, the fact that the standards categorically provides that inventory write-offs, obsolescence allowance, and shrinkage cost should be expensed, your position will be that IS2 should be followed. The provisions of IS2 should be followed, and it is based on the fact that there is no justification when you say the buyers are responsible for the write-offs in inventory. How does the decision of the buyers to return the inventory affect what? Because no buyer will return a product that is not faulty unless it is not what they ordered for. If it is what they want and it is what they requested for, they are going to use it. So how about obsolescence allowance? How about shrinkage in the cost of inventory? They should all be expensed. They should all be expensed. So I know that you may want to write down some things so that you make reference to them, but for the purpose of IFRS and IAS in case study, understanding the scenario, understanding how to apply the knowledge is better, because when you understand, you can express it in your own terms, in your own words. So also because of time, I may not give you notes per se, but because the class is the class is interactive, I believe you should be able to understand what we are doing, such that when we are done, you can even look at it and then be able to form an opinion and write something. So I'm saying that inventory write-off should be expensed in line with the provisions of IS2. This is because there's no justification as stated in this exhibit that the inventory write-off are attributable to poor planning by the buyers. There's no justification for that. So just because you think the buyer didn't plan well. That's why the inventory was written off. How do we, what is the convincing reason, or what are the convincing reasons? So IS2 should be followed. The provisions of IS2 should be followed. Let's move on to royalties. Who is reading for us? Let me see. Mr. Fidelis, please can you read for us?
I'm on transit, sir. I will read the next one.
Okay, that's fine. Prosper, please
So
help
is
out.
it royalties?
Yes, please. Royalties.
Okay, BP Fashions has numerous licensing agreements with foreign brands, and we pay royalties on the brand. IS2 state that royalties paid to our foreign suppliers be included in the cost of inventories. However, royalties are paid when we sell merchandise and not when we order and store merchandise. It was okay. If we do not sell the merchandise, we do not pay royalties. Therefore, I think we should report royalties paid as a selling expense in our management account. Obviously, I know we will need to comply with IFRS for our financial reporting purposes, but we can differ from IFRS in our management accounts, as I believe we do not have to manage our business using the illogical principles. You may also give your opinion on my interpretation of IS2 on the above items.
Thank you very much, Prosper. So just like we looked at inventory write-offs and the storage costs, this one is talking about royalties. So the company has licensing agreements with some brands, some foreign brands, and they pay royalties on these brands. And IS2 provides that royalties paid to foreign suppliers should be included in the cost of inventories. But the company is saying that they only pay royalties when they sell merchandise, when they sell their product. So that means that they are still negating the provisions of IS2. So they are stating categorically that royalties are paid when they sell merchandise and not when they order and store. So that means that if they don't sell merchandise, they will not pay royalties. So based on that, they are saying that they think royalties should be reported as part of selling expense, because that expense is only incurred when they make sales. That's to them, to the management, to BP Fashions, that they only incur expense on royalties when they sell. But IS2 is saying you pay for these brands so that you carry out your production. You are using let's say you are using someone's let's say brands, let's say a design or something to make your clothes, because it's a fashion industry. So they are using a particular design to make their products. Now they are going to incur costs. They are going to incur costs on those brands because they have agreements with these foreign brands already. So they have to pay on the brands that they are using to carry out their production. But they are saying that they only pay royalties when they sell. So whether they make sales or not, well, since they are using those brands to carry out their production, the cost is incurred automatically. So they cannot hinge their cost on their sales. So the company is saying, if we don't make sales, then we are not going to pay royalties. So royalties should be treated as a selling expense in the management accounts. What is your opinion? Who have I not called? Zainab, are you still in transit? Maya, Blessing, can you say something?
Good morning.
Good morning, Blessing.
Sir, an attempt.
Of course, yeah, great.
Okay, sir. Since expenses are recorded when they're incurred and not when they're paid, so I think they should record the expenses according to the provision of IS2 by adding it to the inventory. And then when they finally pay, they can deduct it from maybe their cash or their bank. So that actually did not stop them from recording it when the expenses was incurred.
Thank you very much. In fact, I love the way you started it. Expenses are recognized when they are incurred. That is just the point. Expenses are recognized when they are incurred, not whenever they make the payment. Does not matter. At the point of them entering into this licensing agreement, before you obtain a license to trade with someone's brand, you signed, you've documented, right, that I am going to use your brand. The terms and conditions will be there. The provisions will be stated there. I'm going to use your brand to carry out production, and I'm going to be paying so and so. And then you now come back to tell us that you only pay for royalties when you make sales. No. Expenses should be accounted for when they are incurred. I think that settles it, except you have someone else has an opinion, which we can still take. Do we understand what we've done so far, or what we are doing? Adedayo, Prosper, Believe, Blessing, Maya, Zainab, Fidelis. Let me know if you understand what we've done, or if I need to do a recap of what we've done.
Well, yes, sir.
Okay. So as usual, I'm starting with the requirement, Exhibit 7. Exhibit 7 says,
So you're not sharing your screen.
oh, apologies. Just a minute. Can you see it now?
Yes, sir, I can
Yes.
see.
Email from Dr. Munir Oyemi Lokan to Abdurrahman Ismaila. There has been a number of significant issues arising from the above-named client, and I have just received a mail from the MD of Kudi Microfinance Bank Limited. The bank is requesting for professional advice on how to overcome some of their present challenges, particularly as relating to meeting the minimum capital requirements by the regulatory authority, the CBN, and other related financial reporting challenges which the bank is currently battling with. In addition, the managing director would want us to review the performance of the bank and make necessary recommendations and or suggestions that will guide the board on the way forward. I forward herewith relevant emails and exhibits in respect of the bank, while additional information may be obtained from their correspondence files. I would like you to draft a report from me to the board of directors of KMB for my review. Your report should comprise the following: an analysis of the financial performance of the bank for the year ended December 31st, 2021, making use of the draft audited accounts and domestic report as at that date, Exhibits 10A and 10B, and previous year's accounts from years 2020 and 2019. Your analysis should focus on the bank's financial soundness, earnings capacity, profitability, and other prudential indicators. 2, an evaluation of the options available to the bank for recapitalization purpose. Your evaluation should cover operational and strategic issues relating to each option available where appropriate. You should provide brief calculations to support your arguments. I look forward to receiving your draft report soon. Okay, so looking at these two requirements, can you tell that they are talking about accounting standard here? the requirement did not mention accounting standard, but there's information that is given to us in exhibit 160 in page 168, where you have exhibit 9. Because this company, this is a bank, this is a microfinance bank, right? And a microfinance bank got a letter from one of their sorry, they got a letter from the CBN, the central bank, right? Can you hear me?
Yes, sir.
Yeah, so they got that letter, and they are not complying with minimum capital requirements of the CBN. That's number one. Number two, as contained in Exhibit 10A, there's a draft management letter on the audited accounts of the bank, right? So the management letter that they drafted contains some information. There is information there that we need to look at. Remember, I told you that when they give you requirements, they will give you they will mention the exhibits that are relevant. Look at this now. Let me go back to the requirement to show you what I'm talking about. Okay. The requirement one, where they said you should carry out an analysis of the financial performance of the bank, making use of the draft audited accounts and domestic reports as at that date, Exhibit 10A and 10B. They're telling you that there's something in Exhibit 10A and 10B that you need to look at. So you have to go to that exhibit that they've mentioned. So Exhibit 10A contains information about the draft management letter. That's the domestic report that was written to the chairman of the board of directors of the bank. So let's look at it. The draft audited accounts for the year ended 31st December 2021. Introduction. Having completed the audit of your bank, we hereby highlight our observations, implications, and recommendations for your review and necessary actions. Adoption of IFRS 9. Observation. We observe that your bank is yet to adopt IFRS 9, financial instruments, for the preparation of your financial statements as required by the CBN. Implication. Failure to adopt IFRS 9 implies that your bank has not carried out the necessary evaluation of the impairment of risk assets, such as loans and advances, using the expected credit loss model. You see, the auditors are saying that in the course of carrying out their audit, remember this is a draft management letter. It's a management letter, right? So it was written by the auditors to the chairman, right? This is what they observed from the account. The company is yet to adopt IFRS 9. And what that means for the company is that they are not recognizing impairments. They are not recognizing the fact that, remember, this is a microfinance bank. It means that the bank is giving out loans. The bank is giving out advances. The bank is giving out credits to customers. So is it every loan that they give out that will come back? No. Is it every advance that they give to customers that the customers will just pay back just like that? No. Some of these loans may be lost. Some of these loans will impair. Some of these loans may not come back. They need to recognize that, and they are not recognizing the fact that some of these loans may be lost. Some of these loans will not come back. Some of these loans will impair. That is what this management letter is saying, that the implication for this company or for this bank is that since they are not recognizing the fact that their loans will not come as they are expecting, they may overstate figures in their statement of financial position. Let's assume that they gave out a loan of 10,000 naira, and due to the economic realities, the customer is unable to pay, or there is a possibility that the customer will not be able to pay, and they are still expecting that 10,000 to come back to them, while the customer is only able to pay 4,000 eventually. Have they not overstated figures in their income, in their statement of financial position? They have. So that is the implication for not adopting IFRS 9. And then the recommendation is that recommend that the credit and marketing unit and finance and account department of the bank should prepare necessary schedules that will facilitate the making of necessary provisions on all doubtful and bad loans and advances. This should be forwarded to us for review to enable us to incorporate the impairment losses into the financial statements before the final copies are produced. That is it. So now, before you are able to answer this question, you need to understand IFRS 9, which is impairment of financial assets. Have you done impairment of financial assets? Hello? Hello, class?
No, sir, we've not done impairment yet.
Oh, wow. Okay. Let me briefly, but you know about IFRS 9, right? You know IFRS 9.
So I have an idea.
Okay, let me just quickly run through it. So you have what you call financial instruments, right? So you have financial instruments is made up of financial assets. I don't want to go into the definition and the grammar. I just want to give you a brief an overview. So you have financial assets, you have financial liability, and then you have equity instruments. So financial assets can either be cash, it can be equity instrument of another entity, or it can be a contractual right to receive cash. These are all types of financial assets. Then financial liability is an obligation to deliver cash. So if you've given someone a loan of, let's say, 10,000 naira, the person has a financial liability while you have financial assets. You have the contractual right to receive cash. Then the person has a financial liability to deliver cash. The person has the obligation to pay you, that's to deliver cash. So that is financial liability. So the recognition criteria is that for financial assets, or let's say financial instruments generally, they will arise when an entity becomes a party to a contract, right? So you recognize financial instruments when there is a contract and the entity is a party to that contract. And then you de-recognize financial assets or financial liabilities depending on if the right to receive cash has expired. So if you have the right to receive cash from someone you gave out the 10,000 scenario I gave earlier, you have the right to receive that cash. But let's say it is stated in form of a contract that you are expected to receive this money within a particular period, and then that time has elapsed. So that means the contract has expired. The time lag has gone. So you will not be able to recover it. So you have to de-recognize. So that's the recognition criteria for financial assets. Then for equity is when you have transferred the substantial risks and rewards. Don't worry, you are going to look at the details of all of that. I just want you to have an idea of what financial instruments are all about. Then for financial liability, you are going to de-recognize when the liability has been cancelled or when the liability has been transferred. So let's assume you've decided to cancel the money you gave out to that person. You've said, don't pay me again. That liability is gone. So the person doesn't have financial liability again. So you have to de-recognize it. Then the emphasis for this particular question, the emphasis is on impairment of financial assets. The emphasis here is on financial assets, right? So for financial assets impairment, the first thing you need to understand is that impairment will take place when the asset, when the initial amount cannot be recovered fully. When you are unable to recover fully the amount you gave out, let's say as loan, let's assume you gave out a loan as a microfinance bank, you gave out a loan, company gave out a loan of 10,000 naira, and they are unable to recover. They are unable to recover at the end of the year. That means that it has impaired. It has impaired. So IFRS 9 makes use of a model, right? So that is what this question is talking about, that they need to make necessary provisions for impairment of risk assets. So as a microfinance bank, you are giving out loans and you are not sure 100% whether the customers you're giving out these loans to will pay back in full when the loans are due or when payment is due. So what that means is that you need to make a provision for a possible loss that may arise. So the IFRS 9 makes use of a model called expected credit loss model. Are you guys following?
Yes, sir, we are.
So IFRS now makes use of a model called expected credit loss model. So that model is trying to make provision for possible losses, right? Possible losses that may arise. But IFRS 9 makes it to be in stages. So the stages has to do with timeline. If you give out someone a loan, like this microfinance bank now, the day they give out the loan, that is stage 1. And it is applicable on the day that that transaction happened. That is when you place that loan on stage 1. So you are going to make an estimate of the impairment that will arise. So you make a provision. You call it 12-month credit loss. So it is going to be for the first 12 months, right? That's for 1 year. So at the end of the year, which will now be stage 2. So let's say this company is Kudi Microfinance Bank. So Kudi Microfinance Bank gave out a loan of 10,000 naira to a customer. And the loan started on the 1st of January, 2024. It's just an illustration. I just want to illustrate so that you understand. So the provision will be made from 1st January to 31st of December, 2024. That is 12 months. So at the end of the year, we are going to reassess this loan based on the company's performance, based on economic realities and other factors that will affect the ability of the company to pay back that loan. So at that stage 2, you make, that's at the end of the year, which is stage 2. After making that assessment, right, you now make an estimate called expected lifetime credit loss. That one is lifetime credit loss. Let me take it again. At the end of the year, you will reassess. You assess the performance of the company you've given all your loans. I'm just using one company as an example. It is possible that this microfinance bank will give out loans to many customers. So all of them, you are going to reassess the advances, the money you've given out to them based on their performance, based on the economic indices, based on the economic realities at that time. So you now make a lifetime credit loss provision. Now, when you remember, you are going to be reassessing at the end of every year. So if at all you reassess and there's a possibility that the company or the companies are struggling financially, right? There is high probability now that they will default. Remember that in stage 1 and stage 2, you don't have reasons to be convinced that these companies will default yet. You are just making estimates. You are just making provisions that in case a loss occurs, this is the provision that you will make. But in stage 3, you are convinced there are reasons, justifiable reasons, to show that these companies will not be able to pay back. That means there is evidence of credit impairment. Credit impairment means that you may not be able to recover your money, either in full or part. So you need to recognize this. That is exactly what this question is saying. This is a microfinance bank. And as a microfinance bank, you should make a provision within the first 12 months that you've given out loans. Make an expected credit loss provision. After the 12 months, reassess it. If the economic realities or the conditions or the performance of the company is below standard, and you are convinced, if there are convincing reasons to show that the credits will not come back to you, they will not be able to pay, that means that will result to impairment. So this company needs to recognize or adopt IFRS 9 in the preparation of their financial statements, because the implication, apart from giving them wrong information, is that because they will inflate their figures, money that is lost, they will still be writing that it is part of their assets. So they've given out, they had cash of 100,000, they gave out 50,000 to customers as loans. And because they did not recognize impairment, they did not recognize that the money may not come back, they are still considering it under their debtors figure, because that is what is showing that this is what the people are owing us. So it's still showing as part of their debtors. Meanwhile, the credit has impaired. So management will be presented with wrong information, which will result to wrong decision making. Do we understand this?
Yes, I do.
Adedayo, do you understand this?
How will you, sir?
Believe, do you understand this?
So I do not really understand. If you can explain a bit, just more, I'll be fine.
Okay. Thank you for that. Zainab, Maya.
But I don't really understand it.
Okay. Have you guys done, I'm talking to the people that mentioned that I need to explain again. I want to know if you've done financial instruments.
Yes.
You've done financial instruments.
Did you do impairment of financial instruments? Payment of financial assets. Have you done it? So if you have not done it,
IFRS 16, have you?
no, IFRS 9.
Don't think so.
16 is leases.
Okay.
So you need to do it. You need to look at it. So I'll explain again, but you need to go back and look at it. So we are saying that for financial assets, it is possible that they will impair. What kind of financial assets are we talking about? We are saying that financial assets such as money given out to customers in forms of loans, can impair. Impairment means that the carrying amount of that asset cannot be recovered fully. So if we give out a loan of 10,000 naira, that's the carrying amount of that loan. And if it comes back to us, we are expecting that it should be the same 10,000 with the interest. But if it is 5,000 that comes back, it means the other 5,000 has been lost. It has impaired. That's what IFRS 9 calls it, impairment. It has impaired. So we are saying that for companies that give out loans, advances, and credits to customers, especially microfinance banks, they should recognize the fact that the credits may impair. Loans that they've given out to customers may impair, may be lost, may not come back in full. So they should make a provision. Do you understand to this point? Please answer so that I'll continue.
Yes, sir. Can move on, sir.
So they should make a provision. So what are
Yes,
they
sir.
using? What are they using to make this provision? They are using a model. The standard calls it expected credit loss model, ECL model. So after the class, go and read about ECL model so that you understand better. So ECL model states that financial assets impairment is treated under 3 stages. The first stage is when the transaction has been originated. On the day that you gave out loans to these customers, that is stage 1, the day that the transaction originated. Now, make an estimate of impairment. Call it expected credit loss, which is a 12-month credit loss. That's on the day of origination. So remember, you are making a provision for 12 months. So after 12 months, that's after 1 year, reassess the loan, reassess whether the company that you've given out this loan to will be able to pay back, reassess the loan position, reassess the company, their performance, and alongside other indices that will affect their performance. That is stage 2. Do you understand? That is stage 2. Then, at that stage 2, make an estimate and call it lifetime credit loss. So, just like you reassessed after the first 12 months, you'll be reassessing every year. Now, when you have evidence based on the economic realities, the economic conditions, and the company's performance, there is evidence that this money cannot be paid. This money will not come back, either in full or partially. You are going to recognize credit impairment. Now you are convinced. Now there are reasons that this money will not be paid. Remember that in the first 2 stages, you were only making an estimate. But in this stage 3, there is evidence that the company will fail to settle. The company will fail to settle the bank. So you are going to recognize credit impairment. So it means the implication of that is that if the money you gave out is 10,000 and you are recording your debtors figure as 10,000, right? That will affect the debtors figure, because since they are unable to pay, depending on how much they are unable to pay, you have to de-recognize the value of debtors by the amount of impairment. If the credit has impaired, let's say 5,000, and you gave out 10,000, you de-recognize 5,000. It's only 5,000 that will be remaining under debtors figure. So if you leave it to be 10,000, even though you recognized that there is credit impairment, It means you are overstating the value of debtors. You are overstating current assets. So as a bank, for you to present management with information that will be useful for decision making, this standard needs to be adopted. That is what this question is talking about. The bank did not adopt IFRS 9 using the expected credit loss model. So we are recommending that the credit and marketing unit and the finance and account department of the bank should make correction. They should prepare the necessary schedules that will facilitate the making of provisions on all doubtful bad loans and advances. Do we understand better now?
So I have a clearer understanding. Thank you. Much appreciated.
Okay, you're welcome, please. Can we move on? Okay, I take that as a yes. So I want you to write down something now. I want to dictate so that you write. So that when you go back, you have something to look at. Let it not be as if you only understood and didn't have anything to fall back to. But I want to believe you understand anyways. Are you ready to take down something? Hello, class?
Yes, sir, we are.
Okay, so you can write. Before I dictate, where do you think you know about the 8 skills, right? In case study. So where do you think we are going to position our comments on this? Is it under use of data and information? Is it under professional tools and knowledge? Is it under professional skepticism and ethics? Is it where? I hope by now you know the skills I'm talking about. Hello? Let's say something. So before you place wherever you want to place it, what are we talking about here? We're talking about a standard, IFRS 9. Is IFRS 9 a professional tool? That's what you should ask. You want to put it under professional tools and knowledge. Is it a professional tool? Huh? Are we confused? This one that nobody is saying anything.
Yes, sir, we are confused. I'm confused, sir.
Okay. I didn't mean to confuse you. Apologies for that. So I just want to know if you are familiar with the 8 basic skills. But are you familiar with the 8 basic skills?
Yes, sir, we have them listed, but it's actually how to use them. We are thinking when we start solving questions, maybe we can get used to how they are being applied.
Okay. Has Mr. Lekon taken you yet? Has he taken you in case study yet?
I think we've previously had 2 lecturers on
Okay.
this course. We are the 3rd person, but I don't know them by their names.
Okay, but have you had someone that treated report structure?
Yes,
Structure
sir.
of a report?
Yes, sir.
Where he did overview like from the cover page, executive summary, requirement 1, requirement 2, appendix, and all that. Someone did something like that?
Yes, sir.
Okay. All right. So what I'll do is I'll try to guide you on how to go about it. So for this one, so usually your cover page will be there. as the first item. That's on your page 1. Then you have your executive summary. Of course, your executive summary will be after you've done your report. So your requirement 1 will now start. So under requirement 1, your report will be structured in line with these 8 basic skills. So your requirement 1 we have first point, but you're not going to write, you're not going to put heading that use of data and information. No, you will not do that. You only know that that is that is what you are going to follow. So use of data and information here means that you are going to make use of relevant data and information contained in the case. Let's assume you have information about the company's background, the company's history. That is data and information. You can use it. Let's assume you have done ratio. You've done ratio for, let's say requirement 1 is about ratio. You've done ratio or trend as the case may be, and you have 3 years. So the ratio that you've calculated in your appendix, you represent it in your report under use of data and information, that from the calculations contained in appendix blah blah blah, the company's what was it called, earnings before interest and tax in 2021 was so and so, profit before tax was this. I'm just trying to like give you insight on how you go about it, but it is from your appendix. Those calculations you've done, that is data. You extract it, bring it to your use of data and information, and put it down like a kind of summary. But let's say it's 3 years, so you summarize it. Let's say they ask you to calculate the profitability ratios or liquidity ratios. So you know what liquidity ratios are, you know what profitability ratios are. So the ones that you've calculated, you say that the current ratio was so and so in 2020, why it was so in 2021, and it increased to so and so in 2022, something like that. That will be under your use of data and information. I think I will take time to discuss the 8 basic skills as we progress. So I don't want that to take a lot of our time today. So I think I will continue with that maybe next time when we meet, because I want to finish what I planned for today. I didn't know that I was thinking you have good knowledge of the report structure. So now I'll factor that in my next class, so that as we are discussing, I'll be giving you hints and key points that will be relevant and useful to you as you prepare for your exams. Okay, so for IFRS 9, yeah, you can write. This will be under use of data and information. So you say that IFRS 9 provides that. Are you writing?
Yes, sir.
IFRS 9 provides that companies should recognize impairment of risk assets. IFRS 9 provides that companies should recognize impairment of risk assets using the expected credit loss model. Companies should recognize impairment of risk assets using the expected credit loss model. Kudi Microfinance Bank did not follow this provision. Kudi Microfinance Bank did not follow these provisions. Kudi Microfinance Bank did not follow these provisions. As such, This affected, as such, this affected the management accounts. This affected the management accounts. And by extension, the decision made by the management. And by extension, the decision made by the management. Are you there?
Yes, sir.
It is recommended that the bank should adopt IFRS 9. It is recommended that the bank should adopt IFRS 9. By recognizing impairment of risk assets. The first recognition should be done when the transaction is originated. That is stage 1. We can put in brackets. That is stage 1. Thereafter, the financial assets should be reassessed. That is the loans. We are talking about the loans now. They should be reassessed after 12 months. You can put in brackets stage 2. You can put in brackets stage 2. There should be an estimate. Rather, there should be a lifetime estimate. Lifetime credit loss at this stage. Thereafter, if there is evidence, thereafter, are you following? Are you? Let me know if you are following what I'm saying.
We are
Prosper.
following, sir.
Okay. Please remind me, where did I stop? This should be reassessed, right?
There should be a lifetime estimate. You know, say thereafter.
Yeah, thereafter, if there is evidence that the credits will impair, thereafter, if there is evidence that the credit will impair, can put in bracket, this is the stage when there is default. When there is evidence that the credit will impair, in brackets, this is the stage when there is default. Close brackets. The value of impairment or the amount of impairment should be deducted from the carrying amount. To present or show the fair value or true value of the assets. This will go a long way to enhance good decision making by the management. This will go a long way. I called him. Hello, Prosper.
Where with you, sir?
So this will go a long way in enhancing good decision making by the management. Okay, so that's it for IFRS 9, impairment of financial assets. So I'm going to switch to IFRS S1 and S2. So I'll share an article with you. Have you done sustainability reporting?
No, sir,
So
we've not.
because it's a new area, so it's possible that they may test it because financial reporting or corporate reporting has shifted from just figures. The emphasis is not just on the figures, but they are looking at how is the organization operating. Are they the company, is it sustainable, their operations, what they are doing? Are they operating sustainably? So we need to look at IFRS S1 and S2. So these two standards were issued last year in June. So the adoption, the effective date, yeah, when you read that article, you see everything there. So it's from 2024. So it's possible that I can retest it. In fact, they can test it because emphasis, like I said, the narrative has changed or the narrative is changing. It's not just about financial reports on alone. When you look at annual reports of companies, you see sustainability reports there. So we need to look at IFRS S1 and IFRS S2. So let me share. Yeah, basically, IFRS S1 and IFRS S2, they are looking at, so I need to, hello? I'm having issues with my audio.
We can hear you, sir.
Okay, thank you. So IFRS S1 is talking about climate-related disclosures, right? IFRS S1 and S2, they're talking about sustainability of companies. Companies, are they operating sustainably? So IFRS S1 is about the general requirements, while S2 is about climate-related disclosures. But the whole thing is that, is the company operating sustainably? That's the question. Are they operating sustainably? So we are going to delve into it in details. So what are the indices? When can we say a company is operating sustainably? Because if a company is existing, let's say a factory, for instance, they are producing, and the effect of their production on the immediate environment in which they exist is much, and then they are not concerned about whatever impact they are having on the environment. All they are doing is to report financial performance So the emphasis is not just on the financials again. The emphasis is on the stakeholders. Of course, the environment where the entity operates, they are also the stakeholders of that business. So they need to consider their impact on the environment. So after their production, what happens to the environment? Are they leaving the environment in a better state than they met it, or they are leaving the environment in a worse state than they met it? Let me share this article. You guys should look at it after the class. So possibly next week, I'll go into the details and we'll move on to another topic after that. Just a minute. Let me share this.
All right. Thank you, sir.
Yeah, you're welcome. So, do we have issues with what we've done? Let me know if you have anything where you didn't follow. Let me know. Time for questions. I want questions.